tonight I have a very special guest, one of the winners of the 2013 Nobel Prize. It's Dr. Eugene Fama, known by his University of Chicago students as Professor Fama. Thank you, congratulations, and happy to have you taking the time to spend some time with us today, Professor.
Thank you. My pleasure.
Listen, as a noted economist, when you look at the QE programs as we embark on a two-day Fed meeting, could you tell me your observations about the current program and what you see as potential issues when we get to a point where we have to reverse the interest rate subsidies now embedded in our markets?
Sure. Actually, I've been doing research on that very question for the last 6 months. I think that what they are doing is the effects of it are greatly inflated by the accounts. So what has the Fed been doing? Well, in 2008, they changed the game that they were playing, and they started paying interest on reserves. And they're paying interest on reserves currently at slightly above market rates. Now, what that means is reserves are now basically just short-term debt. So what they've been doing is issuing a lot of short-term debt, $85 billion a month, and using it to buy back long-term debt, with the goal of lowering the interest rate on long-term debt. Now, they take credit for the low interest rates on short-term debt, but in fact what they've been doing should have raised the interest rate on short-term debt, not lower it, because you can't do both. If you're issuing interest-bearing securities to buy other interest-bearing securities, you're pushing up one rate and pushing down the other rate. But what happened? Actually, the short rate fell during that whole period. So,
well, Professor, when I talk to people that are buying cars, when I talk to financing homes, and of course we saw the run-up that started in May in interest rates, all that was called into question. I guess a simple question at this point would be, what we've seen in terms of interest rate volatility and then the Fed pulling back on tapering, is Janet Yellen going to ever find the right time, sir? You know, I know that your market-efficient work has many issues with it, like irrational exuberance. Are we going to have an irrational interest rate market due to some of the inputs of the Fed?
No, because I think they're basically neutral events. I don't think they do very much. They're just
okay. So you don't. When the balance sheet reaches $4 trillion, Professor, yeah. I guess my question is, and the economy down the road, both globally and domestically, starts to pick up. If they want to start to control the velocity, wouldn't it be the normal course of action that they would sell securities to pull some of that capital back in? Isn't that normal operating procedure for a central bank?
Sure. But
okay, so what happens when you have $4 trillion of those securities that you start putting back out there to take the money? Isn't that going to poison the well in terms of interest rates moving up dramatically?
Okay, can I answer?
Yeah.
Okay, so they have $4 trillion on one side of the balance sheet, they have $4 trillion on the other. So all they'll do is get rid of one side, retire the reserves, and that will lower the balance of securities that they hold. It's basically a neutral event. It maybe has a little effect on the shape of the term structure, but it's no big deal. It's not like it was in the old days.
So, Professor, let me interrupt you again. So if it's no big deal, then why don't all central banks just do this to the nth degree and make it a constant day-to-day, week-to-week event where they purchase what's issued, keep interest rates low, and just target a low rate forever? Why won't that work then? Why don't we embark on that as a neo-central banking policy?
Well, there's so much confusion in what you said, it's difficult to answer. They haven't been lowering the short rate. They've been putting upward pressure, and it's gone down despite them. So they don't have that much effect on these rates. That's my whole point. And what they're doing now, and just issuing short debt to buy long debt, that's a kind of a nothing activity.